Bitcoin's latest plunge below $100,000 has traders rattled, with long-term holders offloading $45 billion worth of crypto. Fresh fears as well, spreading across risk assets from equities to commodities. Let's head to Adelaide. We're joined by David Scutt now from StoneX. David, what's triggered the sudden wave of selling and why are long-term Bitcoin holders getting out?
G'day, Aaron. Great to be back. And great question, because that's the answer that everyone's trying to go and ponder right now. The one thing I can go and tell from the price action is that the Bitcoin in particular has really struggled ever since it got above 100,000 per token. And so we've had 400,000 Bitcoin tokens reactivated. That tends to indicate that it's longer term players who are selling into this particular sell-off. And as for the actual reason, well, that is the question at the moment. But at this stage, the price action suggests that even fleeting bounces that we see are getting sold into. And we saw that again on Thursday. We saw a bounce, but it ended up being a dead cat bounce and then sold into again. So Bitcoin sitting just above 100,000 again today, which is a really key support level.
It was meant to be Bitcoin's year, but it feels like it's going to end the way the year started if we carry on this way at least. How significant is that $45 billion dump in the broader context of the crypto market? Is it just Bitcoin?
Yeah, well, it's not just Bitcoin, but certainly Bitcoin seems to be kind of leading the pack when it comes to a lot of other riskier asset classes. This chart here just goes and demonstrates that point. So when you look at when the sell-off started in Bitcoin, it was early in October. And then what we saw is a big pronounced decline. And if you go across, you can see gold, you've got NASDAQ, and you've got NVIDIA. And you can see sequentially with those red arrows that Bitcoin kicked it off, then gold, then NASDAQ, and then the real poster child of this AI trade, NVIDIA, it as well has started to come off the boil. So it seems to be linked to some stretch here. So at this point, I'm watching Bitcoin and crypto markets very closely for clues as to what may go and play out in other riskier asset classes, which I'd include gold in that picture, given the other price action that we've seen this year.
Yeah, this sign, do you think of capitulation or just healthy profit taking at the moment? You mentioned that it started with crypto, then spread to tech stocks and now even gold. But gold's been acting like a meme stock over the past couple of weeks rather than the stability. Otherwise, we would have seen people flocking to gold.
Exactly right, and that's why there's this big question mark. Now, I don't think anyone is questioning gold's safe haven attributes, but it has been like a meme stock. So is silver, so is palladium, so is platinum. All those precious metal spaces have been absolutely wild. There was this incredible rally, then all of a sudden it was a blow off top, and then we've just had this period of consolidation where there's not a lot of ability to go and rebound. And so it's telling you something about the system. These have all been beneficiaries this year of a flood of liquidity into the system. Lots of hot money sloshing around. And the fact that they can't go and rally in this environment now, you ask the question, is all the good news now into the price? Because that would go and partly explain what's going on right now. There is no one left to go and buy. And it feels a little bit like that. I wouldn't call it capitulation at this stage. You'd usually go and see a lot more pain. And right now, it's not been that kind of episode where a really big pronounced decline and then a really sharp snapback, which is always the other hallmark of a capitulation trade.
Look, but gold getting to 4,500, market cap of NVIDIA getting to $5 trillion. It was $4 trillion just a few months ago. Apple going sky high as well. Obviously questions about AI spending. Is there too much? Are we building a bubble? Are businesses actually using AI the way that everyone is expecting? This was always likely to happen. Do you see this as the beginning of something? Because 3 days ago we saw Goldman Sachs and JP Morgan warning about a 10% correction. Recent headlines, a 20% correction.
Certainly, we've seen a lot of pullbacks this year. And the question now is this one, is it going to go and become something more pronounced? I look at the financial conditions at the moment. The Fed is stopping QT at the start of next month. So that should go and at least go and assuage some of those concerns about liquidity that was in the banking system in particular. But when you look at the macro conditions, we've got rate cuts coming through. Economic growth still looks all right. Those conditions combined doesn't give me the sense that we're going to go and see an absolute capitulation. These things really roll over. But you don't know. We're talking about an environment, in particular, you mentioned AI. What the impact of that revolution is going to have on the macro economy is still up for debate. And we've got some data out last night as well, which fanned those fears that AI is going to replace a lot of workers. And you put that into the mix as well. I can see why there's a lot of jitters out there and why risk assets are struggling in this environment, despite what the macro conditions appear to be pretty good.
And then the credit worries as well. You touched on it with the bank, but the week began with concerns about credit worries and that there was a lot of speculation out there about that. Can you explain what the issue is?
Basically, because of the Fed's QT program, so they basically had bought a lot of assets, a lot of mortgage-backed securities, a lot of treasuries, and they were letting them what's called run off the balance sheet. So they weren't reinvesting the proceeds. And so that's seen $2 trillion US dollars or so taken out of the financial system. So that was causing a bit of concern there. There was some overnight reverse repo facilities that were being used, but nothing that's out of the realms of what you don't normally see in day-to-day business. And because the Fed is stopping QT at the start of December, so what they'll do is they'll start to go and reinvest proceeds back into treasuries. That concern should start to go and dissipate. It's not something that is getting the markets obviously nervous. It gets a lot of people given concerns about credit in the past. I can see why it creates some concern, but it's nothing that's actually out there that the Fed is not willing to address, and they already have done that. So I can see why there's concerns, but I'm not concerned myself.
All right, what does it tell us about investor sentiment as we head towards the end of the year? Where are people sitting at the moment? Is it more confusing than ever, or are some people just working it out?
It's a really great question. And the way that I look at it is that I think people are nervous, and nervous on two fronts. Nervous because, as we've touched upon, valuations are very stretched. Everything's run very hard this year. And everyone can see that, it feels frothy. But then also they're nervous to not be in the market, because every time you've seen these episodes where there's been a bit of a wobble, it's been bought straight back up. And so they're nervous not to be invested at the same time. So it is a really interesting environment. Again, the macro conditions suggest that things should be relatively okay. But where it goes from here, the longer this uncertainty persists, the more it's likely, in my opinion at least, to go and lead to like a more pronounced sell-off, where people will say, well, okay, it can't go and keep going higher. We might as well go and take profit. And then that becomes a self-fulfilling prophecy. The more people who think that, the more likely we're going to see some pretty steep declines coming through.
The AI factor is so interesting, right? So we always talk about 7-year cycles. The last correction, big one, was COVID 2020. The next one, obviously due in 7 years from that. But what we see about AI is that you're damned if you do and you're damned if you don't get involved with that one, because they could be really wrong. The general intelligence that we're expecting to come around in 2 years, 2027, may or may not happen. We don't know. Just as AI cars, billions were pushed into that, yet we're still driving cars ourselves mostly. So do you see that people are just uncertain and trying to make the right decisions, but there's so much data coming from everywhere that seems really contradictory?
You're right. No one knows where it actually goes and ends up. I think everyone knows that AI is here to stay in some form. But then you get headlines out overnight. OpenAI is asking for a government backstop for funding facilities. This is a real linchpin. I understand why, they're saying from a national security standpoint, but why can't you get funding from the private sector? What's it say about the finances that it's not willing to be funded for all this massive amounts of investment and the return on capital? It does raise question marks. And then you talk about the other side of the equation, what AI does to general society, particularly when it comes to employment and labour markets. We've seen innovation over decades, hundreds of years go and change the way that labour is conducted and the jobs that we go and do. And so there's naturally going to be a little bit of uncertainty out there. The question is, what does it mean for the broader economy? Is it going to replace a lot of workers? Is that going to go and lead to a pronounced economic slowdown? Is that going to cause deflationary forces? No one really knows the answer, because it is something that is out there at this point in time. A lot of hype about it, but no one really knows where it's going to go and end up.
Yeah, it's kind of like if someone was inventing teleporting, you wouldn't know whether to invest in aviation stocks or not, because you don't know if it's going to work. Just finally, are traders betting on further downside at the moment?
If you're going to go and talk from a money market positioning and everything else, when it comes to the Federal Reserve and RBA and everything else, they're still expecting to go and see more rate cuts coming through from the central banks. We saw the Bank of England overnight very, very close to cutting rates again, despite very elevated levels of inflation there. The Federal Reserve, we got some employment data out overnight, the Challenger layoff series, the biggest 1 month increase in October since 2003. So that caught a lot of attention. It includes public and private sector workers, and that's seen the market's going to add on an additional half a cut. So there's about 84, 85 basis points priced in until the end of next year. But they're not looking at this stage for some sort of calamitous outcome for the economy. A soft landing is still the baseline scenario.
All right, David Scutt, appreciate your time as always. Thank you.
Great to be here.